the potential risk of a downside break at some point is certainly a very high probability given the fact that we're 10 years into a bull market. Now, I'm not saying the break's going to happen tomorrow, because if we take a look at the markets today, they actually did very well. We talked about the fact that the market was in this trading range here that's been running right along the 100-day moving average, and we come back down and retested that. And we talked about this last week, that the market was likely going to rebound off that level. It did, and we said that if we could break out of that range, that we would likely retest the highs that run back to June. That's exactly what happened today as well. We were unable to get above that resistance of those June highs. That was exactly where the market failed last time. We had this correction that lasted about 2 weeks. We now have turned up very sharply. And in the course of just a couple of days, we went from a very oversold condition all the way back to a very overbought condition in a hurry. And I mean, it was literally no time at all that this market went from a deeply oversold condition. This was a tradable opportunity only. This wasn't an investing opportunity. But we're now back as overbought as we have been at basically every other peak, going all the way back to the beginning of this year. Every time we've been at this level, that has been the peak of the market in the short term. Now, ironically, when we look at that and talk about the fact that we're very overbought here, this actually coincides with the fact that after the bell today, futures are pointing lower because the Trump administration has just come out with $200 billion in tariffs against China. That's going to weigh on the markets tomorrow. So look for some type of corrective action tomorrow. Futures are already pointing lower here. And this is really suggestive of a market that we continue to be in, just this big giant trading range we've been unable to get out of. Support still runs solid along this 100-day moving average, but unfortunately there's just not been a lot of activity at this point to really justify on a valuation basis to add more exposure to portfolios. So we're continuing to hold higher levels of cash here. We've been allocated towards bonds, which has actually performed fairly well lately. Speaking of bonds in particular, bonds have turned up nicely. Now, they were down just a smidge today, but not by much. Actually, the overall action today in bonds was actually net positive, even though they basically ended flat for the day. But the important thing here is to really watch what's happening, because we've had a nice upturn in bond prices have been doing very well. Interest rates have come down, and what this really has done for the most part is drive the yield curve, which is the difference in interest rates between the 10-year Treasury and the 2-year Treasury. That is now at its lowest level since the last recession. We've only got about an 11-point spread right now between where the yield curve is currently trading and basically going inverted. Now, the importance of that is that a yield curve tells you a couple of different things. The first is that if the economy was growing really as strong as what some of the headline data says, well, the yield curve would not be nearly inverted. The second thing is that, you know, the negative and inverted yield curve has been an almost perfect predictor of recessions going all the way back to the 1950s. So the fact that you're seeing bond prices rise on the longer end of the curve, and you're seeing interest rates come down, despite the fact that we see all this commentary about great economic growth, etc. It tells you that something is not quite right. Bond prices and stock prices should not be rising at the same time. There should be a rotation structure going on, where money's moving out of safety bonds and into risk equities. If there's a big belief that equities are the place to be and that risk is kind of a risk-on attitude, money would be flowing out of safety and more into stocks, but we're not seeing that. In fact, what we're seeing here is money still moving into bonds as safety trade goes. Lately, utilities have also been performing well. That is something that is also normally associated with a safety trade. But outside of that, we're also seeing the fact that the market is going higher, but only for the very few number of stocks actually driving that advance higher. In fact, in today's Technically Speaking post, we've actually got a clip from Jim Bianco over at Bianco Research talking about the fact that out of all the return that came out of the market this year, the entirety of the return came out of 10 stocks. The rest of the market actually has a negative 0.4 growth rate for the year so far this year, and that's because this breadth of these big companies, Apple, Netflix, Facebook, etc., have been driving the overall value of the markets higher because of market capitalization weighted bases. So, keep a watch here, because these things tell you a whole lot. The other thing to be paying close attention to, there's a lot of money been flowing into small cap stocks lately. Small cap stocks have been doing exceptionally well, But understand that the belief here is that small cap companies are immune to trade wars. It's actually just the opposite. Small cap companies are more immune, are more subject to trade wars than anybody else, and the reason is because they are more impacted by change to prices and cost, et cetera, than a big major corporation. So, for instance, a company like Apple, if a price of something goes up a little bit, they can absorb it company-wise. But a small cap company, smaller companies, don't have that flexibility in their net profit margins to absorb big changes to cost that they can't necessarily pass on to consumers. So while small caps have been performing well in the hiding from the trade war type trade, don't get sucked into the fact that this is always going to be the case. In fact, small caps and mid caps are probably at the most risk right now of a downturn. Again, they're performing well now, and I'm not saying go sell all your small cap, mid cap stocks, but I am saying this is an area you want to pay close attention to. Don't take your eye off the ball, because this is where risk is really beginning to mount up because of the chase of these stocks, particularly over the last few weeks. Outside of that, really the rest of the world, again, when we go back to talk about emerging markets, etc. Again, really just no joy, no love for emerging markets. The reason is that basically, despite the fact there's been company after company coming out talking about how cheap these companies are and you should buy emerging markets, there's absolutely no evidence here that that's the case. And the big thing is that emerging markets and international companies depend on the U.S. for growth. And if our growth is slowing down, they get much lower rates of growth and they get impacted. So be very careful how you allocate your portfolio. Right now, we have no exposure to emerging markets international. We are solely domestic based right now because of this whole issue with tariffs and trade. That's where you need to be as well. Quick break. We'll come back. More of the Real Investment Hour coming up next, right here on the Voice of Texas. Don't go away.
Follow Lance on Twitter @Lance Roberts or go to realinvestmentadvice.com.